Have you ever wondered why only 10% of people succeed in the stock market? What do they do or don't do that makes them successful? In today's vlog, we will explore the answers to these questions and discuss 10 common mistakes that investors make in the stock market. By avoiding these mistakes, you can set yourself on the path to becoming one of the top 10% of successful investors. Mistake number 1. Hot stocks. Hot stocks are companies that are currently attracting a lot of attention from investors due to their strong recent performance or perceived potential for growth. These companies may be hyped up by media coverage, social media, or word of mouth recommendations, causing a surge in demand and often resulting in a spike in their price. However, it's important to note that hot stocks can be risky investments as their high demand and inflated prices may not be based on the underlying fundamentals of the company. This means that their price may not be sustainable in the long term, and investors who buy in at the peak of the hype may be left with losses when the stock price inevitably falls back down to a more reasonable level. Mistake number 2. Avoid investment based on tips. Investing based solely on tips, whether from friends, family, or online sources, can be risky and may not lead to successful investment outcomes. Tips often lack the depth and breadth of information necessary to make informed investment decisions. The source of the tip may have a conflict of interest or bias, such as being incentivized to promote a particular stock or having a personal relationship with the company. Tips may not be timely or relevant, as the information may be outdated by the time it reaches the investor. This can lead to missed investment opportunities or investing in stocks that are no longer a good buy. Mistake number 3. Avoid investment in penny stocks. A penny stock typically refers to a company that trades at a low price, usually under 20 rupees per share, and has a relatively small market capitalization. These type of stocks are often associated with small and early stage companies that are still in the development phase or experiencing financial difficulties. Because of their low price, penny stocks can be attractive to some investors who are looking for potentially high returns in a short period of time. They can be highly volatile and susceptible to wide price fluctuations, and they may be illiquid, which means there may not be many buyers or sellers in the market. Mistake number 4. Avoid to time the market. Timing the market refers to the practice of buying and selling investments based on trying to predict the future direction of the overall market or individual securities. However, timing the market can be difficult and often leads to poor investment results. There are many factors that can influence the direction of the market, including economic conditions, political events, and investment sentiments, and it is very difficult to predict these factors with a degree of accuracy. Even professional investors and market analysts are often unable to accurately predict market movements. Moreover, timing the market requires investors to make two difficult decisions: when to sell and when to buy back in, and getting either one of these wrong can have a significant negative impact on investment returns. Mistake number 5. Investing in IPOs. Companies often choose to go public during a bull market where the stock market is doing well. They sell their shares at a high premium because demand is high and investors are ready to pay. Most IPOs in the past 10 years have been an offer for sale where the company's existing investors or promoters sell their stake to the public. Before the IPO, companies approach anchor investors to buy shares. There is a 30-day lock-in period where insiders and anchor investors cannot sell. After the lock-in period, there may be high volatility and the stock price may drop due to oversupply. It's tough to evaluate a company's potential when it's going public because there is limited information available about its financial and operational history. Mistake number 6. Trading and not investing. In the modern digital era, it's easier than ever to buy and sell stocks quickly. However, trading is not suitable for everyone as it requires constant attention to market conditions and can be emotionally taxing due to daily account fluctuations. While some social media influencers may boast about their high profits, the reality is that only about 1% of traders are successful in the market. Intraday trading activities generate most of the trading volume on stock exchanges, but traders need to achieve at least a 50% return to beat the higher brokerage fees and capital gain taxes. If you are still interested in trading, it's recommended to allocate no more than 10% of your total capital for trading activities. Mistake number 7. Investing without research. Buying stocks when they have fallen significantly from the recent high can be a smart move, provided the company's fundamentals and financial health remain strong and its future prospects are positive. However, if the fundamentals weaken, the stock price may continue to decline. Investing without considering a company's fundamentals is akin to gambling, as eventually luck may run out and lead to losses. On the other hand, when a stock price keeps rising, some investors may experience fear of missing out and buy in without considering whether a stock is still fundamentally sound. If the stock price becomes detached from the company's fundamentals, the risk of loss increases. Eventually, market realities may set in and the stock price may crash, causing those who bought it at the high to lose the most. Mistake number 8. Taking too much, too little, or the wrong risk. Investing involves taking some level of risk in exchange for potential reward. Taking too much risk can lead to large variations in investment performance that may be outside your comfort zone. Taking too little risk can result in returns too low to achieve your financial goals. Make sure that you know your financial and emotional ability to take risk and recognize the investment risk you are taking. Risk number 9. Reacting to the media. There are plenty of 24 hours news channels that make money by showing tradable information. So-called market experts flash stocks to buy or sell every hour, or they give predictions on where the stock will go in the next 1 or 2 months. The media always gets excessively hyped or depressed based on current events and presents a short-sighted view of the market. This also leads the common investors to make unnecessary changes to their portfolio. The key is to parse valuable information out of all the noise. Successful and seasoned investors gather information from several independent sources and conduct their own proprietary research and analysis. Using the news as the sole source of information analysis is a common investor's mistake because by the time the information has become public, it has already been factored into market pricing. Mistake number 10. Investing in companies with diversification. Diversification is a term that describes the situation where a company puts too much money into too many different investments or assets, to the point where the diversification actually ends up hurting their overall returns. Instead of buying back shares or raising dividends, profitable companies often prefer to blow the money on foolish acquisitions. If the subsidiaries companies are into unrelated businesses which are making losses, it means companies funneling profits from good business to fund bad ones. If you like my content, then please like, share and subscribe to my channel. Thank you.